Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Welcome, James.
Good morning, Jim. How are you today?
I am fine, and how are you doing?
I'm terrific.
Awesome.
Yeah, excellent. Glad to have you.
I know today's topic is about Roth IRAs and 401ks.
Correct.
So why don't we start off with some basic information pertaining to the Roth so that we can enlighten our clients. And we may have to break this into two segments because there's a nice component that I think we should elaborate down the road regarding conversions.
Absolutely. Yeah. So I think we should probably cover maybe the
essentials first.
The basics,
Yep.
top 10 maybe.
Go
things.
ahead.
So let's look at the basics as far as what Roth IRAs are, how they started. So they started back in 1998.
All right.
Senator William Roth from Delaware instituted this.
Exactly. And what's the purpose of the Roth?
It is a after-tax retirement plan, as opposed to when we put money into a 401k plan or an IRA, we are putting it in pre-tax and getting a benefit, meaning up front, you're getting a pre-tax benefit. So it's deferred into the future.
Correct.
So when you take out that distribution in retirement, you're going to pay the tax.
So
with a Roth, you don't.
You're paying taxes up front first.
Yeah, or you're putting after-tax dollars.
Right. And the advantage to a Roth by doing that?
Well, the big advantage is you don't pay taxes in retirement when you take out the money. So you're basically, in effect, prepaying the tax for the future.
That I get.
Yeah.
Why and let's go to what the limits are with regards to a Roth IRA.
Yeah. So the limits are, what is it? I think it's 7,000 for the current year. Yeah. And then
catch-up provision?
There's a catch-up provision of another 1,000 if you're age 50 or older. But it's also, you have to have earned income in order to be able to do this. So that's one of the other tests that we don't want to overlook. And there's also for 2025, there's based on your income, your modified adjusted gross income, and your filing status. So for those that are single and head of household, if your income is less than $150,000, not a problem. Between $150,000 and $165,000, it's going to get phased out. Over that, you're not going to be able to do it. You're not going to be able to put a contribution to work.
Interesting.
For those that are married filing joint, less than $236,000. And then between $236,000 and $246,000, so that $10,000, it's going to get prorated. You're not going to be able to do the entire contribution. Anything above that, you're not going to be able to do at all.
So this, in essence, is penalizing those who make too much money.
Correct.
Interesting.
Yes.
Not sure why.
Look, the end of the day, you don't blame the IRS.
No.
The IRS is the enforcer.
Right.
Tax legislation from Congress is the one that put this into play. So basically, they put the legislation into place. Then there's regulations that are to help to interpret what Congress's meaning was behind it. So if you go back and you look at the details, the notes, Congress, you could see what their thinking was behind setting this up. But this is, again, they use taxes or tax legislation to influence, encourage, and in some ways coerce people to do certain things, whether it's, in this case, retirement or education or businesses. It's incentivize or decentivize people from doing things or businesses from doing things. And it's no different here.
I do know that the Roth 401k has no income limits. So that is if a company offers the Roth 401k, a person could theoretically, no matter what their income is, put into the Roth. One of the things that I've noticed, and when I talk to clients in the 401ks and trying to get them enrolled, I've often asked them their opinion as to which way to go. But then I try to guide them. Where do you think that line is of whether to do pre-tax versus post-tax?
It's a great question. I think without question, younger people should absolutely do the Roth in the 401k plan. Now, and I'm not suggesting that they do 100%, but they should have more so than an older individual. We'll touch more on that when we get into the conversions too.
Yes, I think that would be an excellent spot to do so.
And you are right. A lot of companies have added the 401k, the Roth to as an option, and you're at a little bit of an advantage as opposed to the Roth IRA, because you can put in up to the maximum amount. I think now 2025 it's $23,500 and another $7,500 as a catch up for age 50. But again, that's getting into the older.
Right.
But depending upon a client, where they're at in life, sometimes if they have it, I suggest that they do it, because it's no different than I've encountered individuals who have put after-tax contributions into their 401k plan.
Yes.
So if you're going to do that, then why not put it into the Roth?
I agree. It makes it cleaner.
Well, the other thing is that they also have a little bit of an advantage in the future, because when they do leave the company, now they will have a Roth IRA.
Yes.
So that they can, in fact, then do conversions or contributions or both.
Correct. I find it interesting, though, that in the Roth portion of the 401k, there's no income limit, whereas in the IRA, there is.
Well, and how could they enforce it? How could you force companies to enforce that particular thing? So they have to leave it open-ended.
Do you think Roths have any hidden tax benefits?
They do. They provide us with tax-free income.
Okay.
Especially come in retirement or even before.
Hence the reason why you were saying the compounding effect of interest and having somebody younger putting it into a pre-tax or a post-tax situation will allow them to accumulate a much larger bucket that they can receive.
Yeah, absolutely. Also, one thing that I wanted to point out too is, Roths are not going to be considered in the calculation for taxing your Social Security benefits, so that's also a hidden tax benefit, or in the calculation on the tax related to the net investment income tax, which is one of those Medicare surtax nonsense that was instituted back in 2010 under the Obamacare.
So if you're making too much money in your retirement,
unearned income.
Yes, your Social Security is affected.
Yes.
Whereas the Roth doesn't impact that at all.
No.
That's actually good to know. Do you know if the Roth IRAs, like the traditional IRAs, have a required minimum distribution that has to take place?
That's key.
That's a loaded question, huh?
There are no RMDs. Which is really, really powerful. So that's what I have here as a planning note. These rules are really, that people need to know is when it comes to the Roth, there are no RMDs as opposed to traditional IRAs and 401k plans, where there will be when they reach that age of 72 and or 73, depending upon the law change.
There's actually a lot that can happen with regards to planning aspects of that, because how does that impact since there's no required RMD to come out, upon a person's demise, what would happen with regards to the Roth? I'm assuming he has a designated beneficiary listed. What happens to that? This is outside the scope here a little bit, but
Yeah, but again, those are the rules. You're talking about inherited Roth IRAs, right?
yes.
Yeah. So
Are they
RMDs
going?
are still not going to be required.
Yes.
So.
But I understand, though, it still has to be liquidated within the time frame.
Yes, and I
10-year time frame.
That's right. Under the
Okay.
Secures Act.
Just like the IRAs, they too are subject to be liquidated within the 10 years, even though they don't have to pay any taxes.
Exactly. So that's the one distinction with it. Exactly.
So what withdrawal rules do we have for an IRA?
Okay, so let's keep in mind, if we decide to withdraw the funds from a Roth IRA, there are some rules that we have to adhere to. So the one big one is, there are certain tests that must be met first in order for earnings to be tax and penalty free. So firstly, you have to be age 59 and a half or older. So that's really no different with your traditional IRAs as well. You take it before that, you're going to get a 10% penalty and tax.
Correct.
Okay. So the next thing, which is really important, is the Roth has to be open for 5 years. So let's go back to those people that were in a 401k plan, and they effectively have a Roth.
Correct.
So the clock, when does it really start? So that's the other thing, even with conversions, that we have to consider is, when's that 5-year clock start? So let's say, for example, and I have a little bit of an example here. Let's say that if you're 55 and you opening your first Roth IRA this year, 2025, you could take distributions. You would be permitted to take distributions at age 59 and a half. But there's a however. Did they have it open for more than 5 years?
When's the clock start ticking on that?
It actually starts ticking at the last day of the year. So you could do it at any point in time during the year, and it's deemed to be a year. So there's a little bit of an advantage. You could almost have it open for 4 years.
Right.
4 years and a day.
And you could then start drawing.
Exactly.
So in essence, they're looking at it from the standpoint that January 1st, it was officially opened. Whereas
even if you opened it December 31st.
Fascinating. So that's 1 year under your belt. Then you go out 4 more years. So if you started it today, you could start pulling it in 2030.
Assuming you're over age 59 and a half at that time.
Okay. But you were using the example of 55.
Yeah.
So you'll be 60.
But again, that's really important for people to understand the difference.
Now, you mentioned something, and I caught my ear. If they pull it out before age 59 and a half, I know about the 10% penalty because it works the same way for the IRA. But do they have to pay taxes on the gains?
The earnings.
The earnings.
Yes.
So any gains that contract has, they're going to have to pay taxes on as income.
Taxes and penalty.
Okay.
Both.
Wow. So you definitely don't want to pull this until you're 59 and a half.
No, and again, there are some instances where people may have no choice.
Okay.
But we want to avoid it as much as possible, if not at all costs. It shouldn't be viewed as a piggy bank.
Yes. Sometimes that happens in the 401k world where they look at it that way.
Yeah, well, we could touch on a little bit too about conversions, and it's similar to, the clock starts that 5-year period beginning of January 1st. You can make a conversion later in the year, meaning you only really technically have to wait those 4 years before withdrawing and without incurring a penalty. Then each conversion, this is the other thing too, because we'll talk a little bit more about this soon.
Right.
But because one of the planning things that we do look at and want to look at is if people have really large IRAs or 401k plans that we can roll over into an IRA. But in the future, if we decide or want to look at and analyze whether or not they should convert to a Roth IRA, you don't want to do it all at once. typically, because now you're going to push yourself into the highest tax bracket.
Right.
So you do multi-year tax projections and look at it over that period of time, so that you sort of find that break-even point. I know I'm getting a little ahead of myself, but each time you do a conversion, the clock starts
Ticking.
for that each individual conversion.
Contract.
So it can get a little complex.
Yes. Well, when we get into talking about the conversions and the reasons why, we'll address that further. We know that a Roth can't be touched before the age of 59 and a half without taxes or penalties. How would you utilize it for retirement, though?
How would I
I guess what I'm getting at is the advantages is it's coming out tax-free. To generate an income, you know what? I guess you covered that through the piggy bank. Okay, never mind.
That's all right. Well, you're hopefully utilizing it to meet retirement living expenses, right?
Yes.
And so again, that's where we as planners, we're picking different pots of money to help meet whatever monthly
needs.
Expenses that they have. So whether it comes from the Roth IRA, their traditional IRA, Social Security, if they're begun to take benefits, or their pension. So it's all different buckets of money. But do you want to use, does it make sense to use the Roth IRA right away? Or do you wait
For a different time frame?
Mm-hmm. Absolutely.
I guess it also then plays into when you do estate planning.
Yes, because now you're leaving a big bucket of money, perhaps, to your children and grandchildren, perhaps your heirs, and there's no tax. There's no estate tax and there's no income tax on.
So in essence, it becomes a step up, even though on the individual automatically, even though on the individual side they get a step up in cost basis. This would actually makes it a lot easier and cleaner.
That's why some advisors and estate planning attorneys do like the Roth IRA for that purpose.
Can you recharacterize annual Roth IRA contributions?
Not anymore.
Okay.
You could in the past. So in other words, what that really means is if you put a contribution in and then you decide later you didn't want to do it, you could pull it back effectively and say, do over. I don't want to do this. But that changed under the 2017 tax legislation, Tax Cuts and Jobs Act. So beginning in 2018, that went away. Can't do that any longer. You could still recharacterize all or part of an annual contribution plus the earnings, but you can't do that with a conversion. So that's one of the distinctions.
Interesting.
And I think one of the other questions that you asked, are there any benefits for heirs? And I think we kind of covered that one too.
Yes, we did.
Yeah. So if you don't need the money, it can continue to appreciate within the Roth IRA umbrella until an individual's passing. So there's there's some really powerful benefits for making the contributions, and as well as for an estate planning purposes. We also covered the fact that heirs still have to take out required minimum distributions on those Roths. And actually beginning in 2025, certain heirs who do inherit those individual retirement accounts, they have to take those yearly required withdrawals or they're going to face penalties. So they have to basically draw it down over that 10-year period.
I was recently in a class and they talked about a backdoor Roth IRA. Are you familiar with a backdoor Roth IRA?
Mm-hmm.
And I'm assuming, and based on what I've understood, is that it's a way for those who don't fall into that category because they make too much money of opening a Roth to put it into a traditional IRA. And then they convert that to a Roth. How long of a period do you have to wait before that can take place? Because I thought that was actually pretty clever.
It's within the year.
Within a year?
Within the tax year, yeah.
Okay. I thought that was actually pretty clever. But to me, I'd rather put it into a Roth 401k as opposed to.
If the person has that option, many people that don't have that option available to them.
Interesting.
So this
There's
is another
still plans out there that don't have that option, right?
There are, yeah. Not every company has a Roth
401k
component.
Mm-hmm.
Yeah, and you're right about the backdoor. That's another way in which those that do have higher earnings could it's sort of like doing an end around.
Right.
They're able to make the contribution. But the reason why it's in place is for those people that do make a contribution and then realize that their income's too high, that they wouldn't be able to get the deduction. So they're able to move out of it.
Got it.
That's why it's in place. And I don't think that they would change it.
Mm-hmm. Let's hope not.
Yeah. Okay. So do you want to talk about Roth conversions?
Sure. Why not? We're here. When do you convert a traditional IRA to a Roth?
I don't know. It all depends. That's why I say I don't know. Because it's going to depend upon their age and stage of the individual. What kind of planning do we have to do for them?
Right.
And where they are. More importantly than anything is where are they in their tax bracket? So how do you this is where I love getting these questions, and I can't give a definitive answer because it's all gray. It's not black or white.
That is true. And it's that way for each individual.
Correct.
And the only way we can be sure that we're doing the right job is by asking a lot of questions.
And then doing a lot of analyses.
And to determine which way would be best for them.
Yeah, I would be a big proponent of people converting to traditional IRA from a traditional IRA to the Roth IRA. But in the year you convert, you're going to pay the full tax. So you're effectively prepaying tax. So it's not, in some ways, I guess it's not unlike you see a sale in a store and you got something that you eat a lot of ice cream, I don't know, and it's on sale. And so now you're going to stock up on it effectively. So you're prepaying for the future.
Okay.
So in essence, it's similar, but you do have to be careful because you don't want to put yourself into the higher tax bracket. So you almost have to find that break even point.
Okay.
And I think I'm going to give an example. So I had someone who came to me, and she had, I think it was like $1.4 million IRA.
Mm-hmm.
Now it's sort of like coming to me after the fact. There's very little I can do, but she was advised to convert the entire IRA in one tax year.
Ouch.
Okay, that's wonderful. Now, 1.4 million.
That's a huge tax burden.
So you assume 30%, right? So we're talking, I don't know what, $400,000 or so.
Plus, yeah.
Yeah. All right. How is she going to pay for that? She had no cash on the sideline. So that's an important piece of making a Roth conversion. Do you have sufficient cash on the sideline? You don't want to use the IRA assets to pay for the tax.
Right.
But she didn't have a choice. Now, I'm going to add a couple of other elements to this. The value of our IRA went down that year.
From 1.4 to?
It went down like 30 or 40%.
Ouch.
So now what she was forced to do, how is she going to pay for the tax? She refinanced her mortgage on her house and pulled money out of the equity. But rates went up. So she was paying a low mortgage on her interest. Now it's higher.
Ouch.
So that's not a double whammy. That's not a triple whammy. That's a quadruple whammy. This is where it's important to plan.
Yes.
And not overlook those pieces. So when it comes to doing the Roth conversion, we have to look at where the person is, what their tax bracket is. Do they have sufficient cash on the sidelines in their bank account that's going to pay for that tax? So if someone has $1 million plus IRA it's preferable to look at what I call, as a CPA, multi-year tax projections. You do multi-year tax projections and you look at every year and you compare them side by side so that you can stay within the lower tax brackets, that you're not pushing into or butting up against or going beyond into the next tax bracket and paying that marginal tax rate.
It makes all the sense in the world. But I feel sorry for that young lady who...
Unfortunately, she wasn't young.
Oh.
So that's the other piece of it. So now she's also working to make up for the loss.
Oh, that's a shame.
Yeah. So that whoever gave her that advice is a form of malpractice that they didn't consider. You can't give advice in a vacuum. So I don't know, and I don't know the details, but was it somebody that she paid? Was it somebody that just gave her general advice? You can't just give general advice. You need to
have to take everything into consideration.
Exactly. Anyway, so there are other things that we could cover with regard to the Roth conversion. I think, there's pros and cons to it. I think the biggest pro is, yes, you are prepaying and you're not going to have to pay tax during retirement.
Right.
I think the biggest con is, yeah, you're paying taxes. Do you have the available cash? Is there do you have liquidity in your bank account
to take care of that?
To take care of the tax? And you also need to do this planning. And I think oftentimes people either they do it themselves or they may not get advisors who, and I'm not disparaging our industry, but what I'm trying to say is that it's important for them also to realize that they need to do that as well, do the long-range planning and the multi-year tax projections to ensure that the individual has enough. We can look at some examples where people are maybe in their mid-60s. They're not yet collecting Social Security benefits. They've delayed it to age 70. Now they're not working, so their income is lower. And then at age 70, they're going to get Social Security benefits. In 72 and 73, you got to take out required minimum distributions. That's going to bump you up into a higher tax bracket. So That's not the ideal time. It wasn't the ideal time to do prior to 65 when they were working because they were in a higher tax bracket. So now they got this window where it's a lower tax bracket, though that's where the sweet spot for us to do the planning.
But it's important at this point in time that we always do the planning and make sure
regardless, yes.
Make sure the client's not getting hurt.
Yes. Well, Jim, this was a great conversation. We can continue this at another point in time, and maybe we'll talk about Roth conversions and how to eliminate some of the tax liability. And maybe there's some methods and approaches and strategies we could use.
I think that would be an awesome discussion for another day.
Okay.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com, disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. It does not constitute a solicitation to buy, sell, or hold a security or an investment strategy, engage in any financial transaction, and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable,
The advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only, as of the date of the production or writing, and may change without notice at any time based on numerous factors, such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bellpoint Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.